If you buy things you don't need, soon you'll have to sell things you do need. Warren Buffett. This simple yet powerful quote captures one of the greatest lessons about money and wealth. Warren, considered one of the greatest investors of all time, has always advocated that avoiding unnecessary debt is fundamental to building solid wealth. But why is this approach so crucial? And how can his mindset about debt be applied to your daily life? We live in a society that encourages immediate consumption. Credit cards, financing, and loans are readily available, creating the illusion that we can have everything now and pay later. However, what seems like a practical solution can actually be the trap that prevents true wealth accumulation. Debt erodes resources that could be used to invest and build wealth. He understands that every real spent on interest is one less real working for you. To illustrate, imagine two people. The first avoids debt and invests consistently, while the second accumulates debt to maintain a high-end lifestyle. Over the years, who do you think will be closer to financial freedom? It's not hard to see that those who avoid debt have a much better chance of prospering. In this video, we will explore why avoiding debt is essential for building wealth, according to his principles. I will show how financial discipline can be the difference between a life of worries and a life of opportunities. Get ready to understand how small daily decisions can drastically impact your financial future. If you want to learn how to use your money wisely, avoid financial traps, and follow a safe path toward financial independence, stay with me until the end. You will discover that becoming wealthy is not just about earning more money, but most importantly, about avoiding losing it unnecessarily. Now let's dive into this fundamental concept that can transform your relationship with money. Buffett has always emphasized that the foundation for sustainable wealth building is not just about earning more money, but managing it wisely. One of the pillars of this financial management is avoiding unnecessary debt. For Warren, debt is not just a financial obstacle, but also a risk that compromises the freedom to make strategic decisions. He believes that wealth is the result of a long-term mindset. Debt, especially consumer debt, works in the opposite direction of this philosophy. When you go into debt to satisfy immediate desires, you compromise your ability to invest in assets that grow over time. He himself has said, "What matters is not how much you earn, but how much you keep and how that money works for you." Debt works as the opposite of this. When you're in debt, the money that could be invested in stocks, real estate funds, or even financial education is being used to pay interest. Let's imagine you have a credit card debt with an interest rate of 10% per month. This percentage is much higher than the average annual return of the stock market. While disciplined investors patiently wait for long-term returns, those in debt pay extremely high interest that grows exponentially. A fundamental concept he advocates is living below your means. He himself is an example of this. Despite being a billionaire, Buffett lives in the same modest house in Omaha, Nebraska, that he bought in 1958. He drives regular cars and maintains a simple lifestyle. This behavior demonstrates that true wealth is not about showing off, but about accumulating assets that generate value. Debt often arises when trying to maintain a lifestyle that doesn't match one's financial reality. Many people try to appear successful by buying expensive cars, the latest smartphones, and taking finance trips. This kind of behavior creates a cycle of credit dependency, harming wealth building. He describes compound interest as the eighth wonder of the world. When you invest, compound interest works in your favor. But when you have debt, especially high-interest debt, that same power works against you. To illustrate, imagine a credit card debt of 5,000 Rs with an interest rate of 10% per month. If you don't pay it off, in just 1 year, this debt can exceed 16,000 Rs. The same principle that could multiply your money and investments is, in this case, multiplying your debts. He understands that those who comprehend compound interest earn from it, Those who don't pay for it. In the investment world, Buffett has always sought solid businesses with predictable cash flow and little need for external capital. He avoids highly leveraged companies because he knows that debt can put any business at risk, especially during times of crisis. Similarly, in personal finance, leverage, excessive use of credit, exposes individuals to unnecessary risks. A sudden change, such as job loss or a medical emergency, can push someone in debt into a financial crisis. Warren avoids this risk in his companies and recommends the same for personal finances. Dave Ramsey, a personal finance expert, built his fortune after losing everything due to being highly in debt. Inspired by principles similar to his, he advocates for the complete elimination of debt before starting to invest. Ramsey emphasizes that without debt, money begins to work for you, not against you. This example reinforces the idea that avoiding debt is not just a financial strategy, but a path to freedom. Being debt-free allows you to seize investment opportunities and consistently build wealth. Avoiding debt doesn't mean stopping living, but rather choosing to live with financial intelligence. It's about prioritizing what truly matters and building a solid foundation for the future. Buffett has always emphasized that building wealth is a slow and steady process. He believes that patience and discipline are key ingredients for financial success. Many people look for shortcuts to get rich quickly, but end up exposing themselves to debt and unnecessary risks. One of his striking quotes reinforces this idea. The stock market is a device for transferring money from the impatient to the patient. This means that those who act on impulse and chase quick gains often make poor decisions, while those who wait for the right moment reap great rewards. By avoiding debt, you create space to be patient. Without the pressure of bills to pay, you can wait for the best investment opportunities. Warren, for example, spent years observing companies before investing, always looking for solid businesses with growth potential. He knows that patience allows for rational decision-making and helps avoid costly mistakes. Buffett is a master at identifying undervalued companies, solid businesses that the market is overlooking. He only invests when he is certain he is paying less than the company's actual value. This same principle can be applied to personal finances. When we're in debt, we lack the flexibility to seize good opportunities. Imagine a great property becomes available below market value, or the stock of a promising company is selling at an attractive price. If you're trapped in debt, you simply can't take advantage of these opportunities. He avoids companies that rely on loans to grow because he knows debt can destroy businesses. Similarly, he advises individuals to avoid debt so they don't compromise their ability to invest. Carefully evaluating opportunities and avoiding financial traps is a way to protect and grow wealth. Warren sees market crises as great opportunities. While many investors panic, he buys quality assets at low prices. During the 2008 crisis, for example, he invested billions of dollars in solid companies that were temporarily undervalued. This move generated huge profits when the market recovered. But how does this apply to your financial life? Simple. Those who are debt-free can take advantage of crises to buy cheap assets. During times of crisis, real estate, stocks, and even businesses can be acquired for much lower prices. However, only those with available resources can seize these opportunities. Debt, on the other hand, prevents this flexibility. Those in debt suffer even more during crises because they must prioritize debt payments while quality assets are on sale. He shows us that having liquidity and avoiding debt are essential strategies for building wealth through the ups and downs of the economy. Another important aspect is financial discipline. Warren never invested in something he didn't understand. He avoids passing trends and prefers simple but profitable businesses. This discipline also applies to managing debt. To avoid debt, it's necessary to maintain consistency in financial habits. This involves spending less than you earn, avoiding impulse purchases, planning major purchases in advance, building an emergency fund. These actions may seem basic, but they are powerful. Daily discipline is what allows wealth to accumulate over time. He shows that there's no need for complex strategies to build wealth. The secret lies in consistently following simple principles. He values simplicity in finances. He avoids unnecessary complexity and invests only in what he understands. In personal finance, this means making conscious choices and not being swayed by consumer marketing. Many debts result from impulsive decisions. Buying expensive cars, the latest smartphones, or financing trips are examples of expenses that can be avoided. When you understand your real needs and resist the urge to impress others, you avoid debt and direct your money toward what truly matters. Buffett also advises knowing your limitations. Just as he doesn't invest in businesses he doesn't understand, you should avoid debts you can't control. Financial self-awareness is essential for maintaining a balanced life. A practical example of his philosophy was his decision to invest in Goldman Sachs during the 2008 financial crisis. While the financial world was in panic, Warren saw an opportunity. He injected $5 billion into the bank under favorable conditions. When the market recovered, this investment generated billions in profits. Imagine if he had been in debt at that moment. He wouldn't have had the resources to seize that opportunity. This example reinforces that avoiding debt and maintaining liquidity are fundamental strategies for thriving. By understanding how patience, discipline, and careful evaluation are essential, you realize that avoiding debt is just the beginning. True wealth comes when you combine these principles with the ability to act strategically. Now is the time to reflect on everything we've learned so far. Buffett has shown us, through his life and investments, that avoiding debt is not just financial advice, but a life philosophy that allows you to build wealth consistently and securely. By following these steps, you will be on the right path to achieving financial stability and, over time, reaching financial independence. Warren built his fortune not only by choosing good investments, but also by maintaining a life philosophy based on prudence, patience, and the intelligent use of money. If you apply these principles, you can significantly transform your financial reality. Remember that building wealth is not about earning more, but about managing what you already have better. And that starts with the conscious decision to avoid debt. If you enjoyed these lessons and want to learn more about how to achieve financial success inspired by great investors, don't forget to like this video and subscribe to the channel. That way, you won't miss any content that can transform your perspective on finance and investments. See you in the next video.